Hello, and thank you again for joining me on the FT Global Boardroom today. Soon it will be time for me to hand over to Andrew Hill, the FT's management editor, who's going to be introducing and summarising the rest of today's panels until about 5 o'clock UK time, when we hand over to New York. So just before I pass on the reins, I've got time to read out a very quick tweet from Susan Robson, who's using the hashtag FT Global Boardroom. She says, George Parker is the most amazing interviewer. I have to say, absolutely correct there, Susan. If you watched the session with Kim earlier, you would certainly agree with that. A great job, and done on a very few hours of snatched sleep after writing a huge story breaking overnight for the FT. Now, just before I pass on the reins, I'm delighted to introduce our next speaker, C.Williams, who is the 11th President and Chief Executive Officer of the Federal Reserve Bank in New York. Now, as New York Fed President, Mr. Williams is also Vice Chairman of the Federal Open Market Committee, and he'll be talking to Gillian Tett, Chair of the Editorial Board in the US. Now, immediately following this fireside chat, we'll have our second extra time session of the day. What's that, I hear you ask? Well, Gillian will be joined by the FT's US banking editor, Laura Noonan, for some on-the-spot analysis of Mr. Williams' comments, and they'll also answer your questions. So do be thinking of what you'd like to ask. You can put them through the box on the right of your screen. So I'm afraid it's goodbye from me, but next up, it's Gillian, and I do hope you enjoy the rest of the FT's Global Boardroom.
Good morning, everybody, or good afternoon, good evening, good night, wherever in the world you're watching. Hello, my name's Gillian Tett, and I am delighted to be joining President C.Williams, who runs the New York Federal Reserve, for a conversation about what on earth is happening in the markets, the economy, the government, and much else besides. I can't frankly think of a better moment to have a chance to chat to him, because we are obviously in a very delicate political juncture in America right now. I'm talking from New York. We just had indications in the last few hours that there's a good chance that someone like Judy Shelton, one of Trump's nominees, will be on the Federal Reserve Board soon. We're also at a very delicate economic juncture, given that COVID-19 is spreading, even in New York, which has hitherto been relatively calm. We're seeing new controls come in. So many people are asking what's happening to the economy. But also, in the last few days, we've seen an explosion of discussion about whether inflation is something that people should start worrying about again soon or not. So, President Williams, welcome. What an incredible cocktail of issues to be looking at right now. Perhaps I can start by asking you the most basic question, which everybody wants to know. What is happening to the economy right now, in your view, in America? And should people be worrying about inflation and or worrying about a steepening of the yield curve next year, as Goldman Sachs came out early this week and warned?
Well, on the economy, the news has been really much better than expected. I mean, GDP growth was really strong in prior quarter. Employment growth has been, very positive, very robust. It has continued through October. Other indicators of the economy show either, continued growth, although a slowing pace, as we would expect, given, the very rapid rebound early in the year. So I think the economic indicators, including some of these high-frequency indicators they're all, learning about and watching very carefully, still show the economy on a positive trajectory. That said, the very large rise in COVID cases recently, that's clearly puts a question mark on the ability of the economy to kind of weather this period. So I would expect the growth in the fourth quarter and, maybe into early next year to slow somewhat. I still think what we've learned from the past 6 months or so is that people have learned to navigate COVID in terms of, the economy. We see the economy continue to grow despite a second and maybe a third wave of cases. So I feel relatively positive around how the economy is evolving. That said, there's just a great deal of uncertainty given the rapid rise in cases and some of these, how will that affect the economy. Longer term, I mean, the big issue obviously is vaccines and therapeutics, and really, the ability to get us fully past COVID. And there we've seen some positive news. Now, we're not going to have vaccines, immediately, but I think that the science has made a lot of progress. I think those are positive signs about next year and the ability to really get past COVID over in the next year or so.
What about, looking ahead though, if you think things are looking better, are you concerned about inflation?
So, I think things are looking better, but that's, in context of an economy that took an enormous hit. We lost, millions and millions of jobs. Obviously, even today, unemployment is still very high. And we're still in a deep hole, if you will, in terms of where the economy is relative to, where it was in February or where it really should be if we were at full employment. So let's not, I think that's the context of thinking about things. So when I think about inflation, we've seen global disinflationary pressures over the past decade, partly because of the economy struggling to recover from the global financial crisis and other events before. Still, the global economy is quite weak. So I see a lot of downward kind of momentum or pressure on inflation. So right now inflation is running about 1.5%. That's it's below our 2% goal. But I do think that, the real issue that we're going to be dealing with is inflation that's a little bit lower than we want over the next few years, not really high, given the fact that we're going to be an economy, both in the US and globally, that is struggling to get back to full strength over the next few years. Even with this, I think, some positive signs on vaccines and other matters.
So when Goldman Sachs came out and said, we're going to have a significant steepening in the yield curve next year, investors need to prepare for that. Do you think that is a fair call or a sensible call?
Well, one of the things we've learned in the past 8 months is that, financial markets, and understandably so, but financial markets are much more focused on COVID because that's the primary driver of the global economy right now, than they are about normal kind of macroeconomic data and the ups and downs of employment reports and GDP. So it's in a way, the financial markets are have been reacting, I think, mostly to COVID-related news, and that's still a great deal of uncertainty, both about what's happening now and obviously about what's going to happen over the next year or two. So when you see the rise in 10-year yields, for example, that we've seen over the past period of time, a short period of time, a lot of that's really related to some of the positive news around vaccines and things like that. So I'm not going to make predictions about where the how the bond market, stock market is going to behave. But what my interpretation, at least, is some of this response is not really about inflation taking off. We don't see that in the market-based or survey-based measures of inflation expectations. It's more about I think a more positive view of the economic outlook, or maybe to be more precise, some of the tail risk seems to have gone away in terms of vaccines. And so it's not surprisingly, though, that news means that bond yields move up somewhat. I mean, they're still by historical standards, still quite low.
Well, I'm in the camp, though, that if you do think the economy is going to be recovering, if you do think we have more positive news coming down the track, why on earth would you pledge to keep rates at effectively zero for the next 2 years and essentially pledge negative real rates? Because isn't that just going to encourage more financial market froth as people dash into any kind of, risky potential investments to try and find some yield?
So first of all, I don't think of the verb pledge as the way I would describe how we communicate monetary policy. In our FOMC statement, we have made our expectations of the future path of the federal funds rate, which is our primary policy tool, really based on what happens with the economy in terms of where we are in terms of maximum employment, reaching maximum employment, and obviously around a 2% inflation goal. And so, that state can, technical word is state contingent, but basically it depends on what happens. It's data dependent in that way, means that the path for future policy is really going to depend on what happens with the economy. So if things work out a lot better, than a lot of people expect, things, we get really good news. Obviously, that's going to be a stronger economy, and that's going to pull forward somewhat the time that we would expect to raise interest rates. And if the economy, on the other hand, struggles to get back to full strength, that would tend to move it out. So I don't see this as a date-based pledge at all. It's really about, it's going to be driven by what happens in the economy, which I think is, driven in large part by what happens with COVID. So that's the way I see that. Now, the second part, so the goal of monetary policy is to get America back to work, basically get unemployment down to low levels, get inflation, 2% or back on average to 2%. So I think that the low interest rate policies, the policies we've taken, have actually helped us achieve that. And most importantly, as we get through COVID, will provide a monetary support for the economy. Lower interest rates have already helped on getting the housing market back, recovering. We're seeing that in durable goods, cars, and things like that. So I think monetary policy is having real effects on real, jobs and the real economy, and that's really what we're focused on.
So just to clarify, you are still data dependent, not time dependent, in terms of forward-looking monetary policy.
Sure, and that's the way the FOMC statement is worded. Now we have put out our economic projections, which include the dot plot, and to me the right way to think about the dot plot is about the people's participants' expectations of interest rates is given your view of the economy, given how you expect employment, inflation, other risks to the economy to develop. How do you see what's the appropriate path for monetary policy? But if the outlook changes or the risks to the outlook change, obviously people would take that into account in thinking about what the appropriate policy is as well.
So we have a fairly strong likelihood that next week the Senate will pass Judy Shelton as a potentially new member of the Fed board. Of course, there's a second potential candidate too. Do you think that with somebody like Judy Shelton on the Fed board, that there's going to be more pressure to essentially try to protect the value of the dollar and to push back on the super loose monetary policy?
So first, the decision about who to appoint to the Board of Governors, that's the president's call, and it has to be confirmed by the U.S. Senate, and those are decisions made by others. And so, I don't really have any comments on that. I'm clearly not going to speak for others about what they're going to, what they would or would not propose. Leave that to as events unfold. Right.
And just again to clarify, because this has been an area where there's been a lot of discussion in the markets, when Chairman Powell came out in August and said that they were going to try to target an average inflation rate around 2%. To what degree do you think that means that you can let inflation run above 2% for a year or two? Is it just a short-term average or a longer-term average? How do you calculate that average?
Well, first of all, I think of this as personally, and speaking, how I think about it. It's not a mathematical formula. It's not, we're taking an average over a certain period of time. It's really more of a concept of having well-anchored inflation expectations at 2%. So, to me, the real goal is to have low and stable inflation around 2%. And success will be that inflation expectations, how people think about, hey, I'm thinking about buying a car or a house or making some decision, thinking, well, what should I factor in terms of inflation? And that should be something consistent with our 2% goal. And to me, just kind of, there's a sense that this isn't a complicated economic model. It's a basic principle that if you on average, over longer periods of time have inflation around 2%, then that's what people will expect in the future. And of course, we have to be, take actions consistent with that. And so that does mean, I'm now going to do my little graphical representation. It means that sometimes inflation runs below 2% because of a deep recession like we're experiencing today. And that, just from logic, inflation has to exceed inflation somewhat exceed the 2% goal over some period of time. So the question is, what is moderately in some period of time? I think it depends on, how much of the undershoot we experience and what do we need to do to keep the inflation expectations anchored at 2%. Again, it's not a mathematical formula, but success is that, people understand that 2% is not only words that we say, but it's actually something that we deliver over longer periods of time.
Right. We're getting lots of great questions in already, but I'm going to try and keep touching as many topics as I can. Climate change. Chairman Powell came out in the last day essentially indicating that not only is the Fed going to join the network for greening the financial system, but it's now an embedded part of how the Fed is looking at financial stability. Are you going to be asking American banks to do essentially reports to adopt TCFD? Will you adopt TCFD yourself inside the Federal Reserve to try and give more clarity to these issues? And should the American financial system be preparing for a rapid embrace of green reporting?
Well, I do agree that thinking of climate change is one of the, very important risks to both to the financial stability, but also thinking about making sure that financial institutions of all kinds understand the risks that they face with the investments they make or the loans they make in terms of climate change. I think that's absolutely essential. So how that plays out over the next few years, I mean, that's still to be determined. But I go back to principles. You think about prudential supervision is about the safety and soundness of banks or other financial institutions, and safety and soundness, really requires the institutions to understand, what are the risks that they have, manage those risks, and have all of those kind of things in place on an ongoing basis. So I do think that TCFD and disclosure in general is an important component of that. Having transparency, having that information is an important component of it. And obviously, having a strong risk management at the financial institutions about what they're facing related to climate change, but more, obviously more generally in terms of the risks they see. So I think this is a natural progression in thinking about both kind of standard prudential supervision and regulation, but also, as was pointed out, from a financial stability point of view, about understanding the broader context of the risks to the financial system. And what's important about this is obviously, we're getting this is an issue in the U.S. obviously, but it's also a global issue, and the G20 and the Financial Stability Board have had these issues very much front and center in that work. So I think that's all of us working together and how to approach this effectively, these issues effectively is going to be very important.
So how soon will climate change be part of bank stress test inside New York or America?
Well, I think that's a decision to be, like I said, the things decisions will have to be made, and that would be over time. So I don't have a prediction in particular about that, but I definitely, the conversations around do the financial institutions understand the risks? Do they have the information? I mean, those, that's already beginning. I think one of the things we have learned, and this is, not just in the U.S. but more broadly, is having good information is the first piece of that, and we don't have that yet. We don't have broadly a good data and metrics around some of the climate related risks. So I think that, to me at least, needs to be an early component of progress on this work.
Right. I'm just looking at the questions we're getting through. We got a question saying, does the Federal Reserve see the stopping in the use of physical cash in favor of a digital currency in the next 10 years? Will cash disappear?
So people have been predicting the disappearance of currency. We're talking about paper currency, I think here, for as long as I've been in these kind of roles. And yet paper currency volumes continue to grow very rapidly, partly because of the very low interest rate environment, partly because of concerns around, the financial crisis, or, concerns around the availability of financial transactions, during COVID and things. So we keep hearing about the demise of currency and people moving to more digital payments, but yet currency demand continues to grow nevertheless. I think that, two things I'd say about this. One is a lot of, the vast majority of payments are already digital, right? Wholesale, retail payments are electronic, and we've been, at the Fed, have been pushing hard to keep modern our payment systems, but also introducing or developing the real-time gross settlement system, which is called FedNow, to basically have a very consumer-friendly infrastructure for payments starting in the next few years. So I think that there's already a lot of work about improving, modernizing, and making more accessible payment system. Now, in terms of digital currencies, I think that's obviously an idea that's getting a lot of attention. There are clearly, some advantages around that, and there some other risks, especially around, money laundering and things like that. So those are issues that I'm sure will be front and center for the next few years. But I am not going to make any predictions about paper currency going away in the next 10 years, because I think there are reasons people like to hold paper currency, and I, not so much for going shopping and buying things, but for store value. And so I think that we're probably going to be in a world where there's multiple types of payments that people do.
Right. And related question though, Ant Financial has put the question of deep learning and finance on the agenda. And, there's all kinds of questions about why the regulators and Chinese government balked on that. But it does raise a question of what are Western regulators, what is the Federal Reserve going to do faced with banks who have incredibly complicated AI systems, deep learning systems, that are exponentially harder to understand, track, monitor because of network effects than anything we've seen before. Does the New York Fed have a policy on this? Do you think you have any chance of understanding what's going on in finance with a world full of, if not Ant Financials, but people like Ant Financial?
So I think this is another obviously high priority for us, and we're working actively on that in the Federal Reserve and with our colleagues at other central banks around the world, is growing and building that expertise in artificial intelligence and in a lot of these areas, because they are becoming, for a couple of reasons. Well, one, you already mentioned, this is becoming tools that are used in financial institutions for lots of different purposes. So as supervisors and regulators, we need to understand how those work. We need to understand the implications of that. The second is, of course, as central banks and doing monetary policy and supervision and financial stability work, we need to take advantage of some of these new methodologies and tools in our own work. And so we've been investing in that as well in terms of economic analysis, but also using really these kind of tools for a broader set of issues. So there are multiple reasons we need to be very capable in these areas that I just described. In terms of how should we think about this? I always go back to the principles of what we're trying to achieve. And so the principles really are about whether it's around fair lending or access to credit, about an efficient, competitive financial system, whether it's about money laundering or issues like that. It's like we want to make sure that those kind of social or public purpose principles are driving things. Personally, I want to see innovation. I want to see new technology used in a good way, but be used effectively. But at the same time, I think from our point of view, we want to make sure it's serving the broad public. It's not harming various groups inadvertently or however. And that's one of the I think to me one of the biggest challenges with artificial intelligence is that it's all data based. And data is backward looking, and you don't want systems that allocate credit based on how credit was allocated in the past, knowing that there are inequities and issues with that. So I think that those are things we just need to be very focused on, and making sure that the technological advances are improving the economy for all people, for all segments of society, and so that's just going to be the work we'll be doing in coming years.
Right. We have a question, a very different topic. Do you believe in modern monetary theory? Does the Fed have any limitations when printing money in the future?
Do I believe in monetary? It sounds a little bit like a faith thing. I think that modern monetary theory is highlighting the interactions between fiscal and monetary policy, which we've studied as economists, for decades, and in highlighting in a very low rate environment, a zero interest rate environment, how monetary and fiscal policy interact maybe differently than they at other times. And this has been studied by a lot of economists. Personally, my view is that it's highlighting the importance of fiscal policy at times where interest rates are near zero. It's also highlighting the fact that at very low interest rates that the cost of debt for governments is less. That's kind of mechanical with low interest rates. So I think it's highlighted some important issues. I think personally, I think that I just go back to, let's understand how does fiscal policy help support the economy and the recovery? How can monetary policy also support that, as opposed to some kind of grand new theory of macroeconomics.
Right. So very last quick question then leading out of that is, if we have President-elect Biden in the White House in January, are you hoping to see a big stimulus package? And is that baked into Fed models looking forward?
Well, our economic models, we have to put in assumptions about fiscal policy, federal fiscal policy, state and local and things. And so I think to me, the lesson of the last 9 months is scenario analysis on everything, whether COVID, fiscal policy and things, and understand how different fiscal actions would affect the economic outlook and how that maybe affects our policy choices. So that's just what we do as a normal course of business. I'm not obviously going to give advice to vary about what Congress or different people should do. My view on fiscal policy is that we are still in an extraordinary situation with COVID. And one of the lessons of the last 9 months was the very rapid action by Congress this year in making sure that getting income to lower and moderate income families, to small businesses. That made a huge difference. The reason consumers are still able to spend today, the reason the economy is still going, is that we know that people are still have some of the unemployment checks or stimulus checks that they got. That's giving them the ability to keep paying the rent, put food on the table. And I think that's been an important component of this economy continuing to weather this very difficult situation. And,
right.
that's what I take from that.
Thank you. Well, we are indeed, in many ways, people have warned, heading for a long, dark winter. It's going to be a tough winter, but very best of luck in trying to navigate this. You've given us a lot of food for thought. Anyone who wants to see us discussing this at the Financial Times afterwards, I'm going to be talking with Laura Noonan about some of the implications of what's happening inside the Federal Reserve right now. And it just remains for me to say, on behalf of us all, thank you and very best of luck in navigating these times, particularly speaking as someone who's a New Yorker. Thank you.
Thanks.